And we have a few on Facebook. So for those of you on Facebook, thank you for joining. We are here with Jillian Harrington and Bonnie Santschi. We have a lot of information to go over, really important stuff to cover about the Paycheck Protection Program and Eidl, as well as the some provisions within the Families First Coronavirus Response Act. So as I said, I'm here with Jillian Harrington and Bonnie Santschi. I just want to say thank you to our program sponsor, STCU. And with that, I will go ahead and turn it over to Jillian, and she can take it from here.
Hi, everybody. I'm Jillian Harlington. I am a partner with the law firm of Walker, Hyde, Meehan, and Eisinger. My practice really focuses on advising businesses, everything from employee and customer relations to transactional, as well as litigation. So really, I've been spending the past 6 weeks of my life working from home and advising my business clients around some of these new acts that are coming out and how to kind of deal with the economic fallout that we're experiencing right now. So as the attorney of the group, I'm going to give us a little disclaimer for both Bonnie and myself. The information that we're going to cover today is going to really be a good starting point for you to start a conversation with your attorney or your tax advisor. The information we cover is going to be pretty high level, meaning it's really not going to be fact specific to your situation. So if you do have particular questions, please reach out to your professional that you typically use to talk about how these different laws can impact your business and how they can be used. And I'll turn it over to Bonnie to introduce herself.
Thanks. Hi, my name is Bonnie Santschi. I'm a manager at Northwest CPA Group. I worked in the Seattle area for about 10 years and then moved back to the Tri-Cities in January 2018 and started with Northwest CPA Group. So my practice generally I work with small businesses, owners of those businesses, and then individuals that just want their 1040s prepared. So, and then back to Jillian, we can get started, I believe,
Sure.
On the Paid Leave Act.
Yeah, so today we're going to go over a couple of things. The first thing that we're going to cover is the new paid leave requirements. Some new federal guidelines came down mid-March that really affect small employers. And our community is full of people that are affected by these laws, so I'll go over those. Then Bonnie is going to talk about the tax implications of that new paid leave law and a little bit of leeway that employers are getting for the additional amounts that they're going to have to spend potentially with employees out of the office. We'll also cover the federal financial aid programs that Congress passed recently for businesses. Just a quick note, applications for both of those programs are currently closed. We're anticipating and hoping for additional funding from Congress. But a lot of businesses in our area have applied for and have received their loans, and it's pretty important to know how to apply those proceeds and some additional details that we'll go over. And then finally, I think Bonnie is going to cover a little bit about the individual stimulus payments that folks are seeing or expecting and hoping to see. Yes. So I'll start with the paid leave obligations. So back in mid-March, we got our first coronavirus law at the federal level. It's called the Families First Coronavirus Response Act. And this act was really intended to help folks maintain their employment and maintain their wages as we kind of ride the storm of coronavirus. So these acts apply to employers that have 500 or fewer employees. Although there is an exception, if you have fewer than 50 employees, you can potentially qualify for an exception from the requirements of this act. But again, those are really fact-specific determinations, whether you qualify for relief from these requirements, and it's something that you should be in close contact with your advisors about. The first type of paid time off that employers are now required to offer to their employees And again, this is over and above what Washington State already requires or what the company already offers. So this is going to be in addition to any other benefits that are already out there for employees. It's going to apply to both part-time employees and full-time employees. So the first one is the emergency PTO entitlement, and this is up to 80 hours for full-time employees of paid time off. For part-time employees, it's going to be the 2-week equivalent. So if your employees are part-time, they're working 30 hours a week, they're going to have 60 hours available of paid time off. This paid time off is, there are a few different things that can happen to make an employee eligible to take this type of paid time off. This isn't vacation time or vacation hours. And I'll break them down into 2 categories. The first category is reasons for which the employer needs to continue to pay 100% of that employee's wage for the 80 hours or the part-time equivalent for 2 weeks. Those categories are if your worker is subject to a governmental quarantine or an isolation order, kind of like we are here in Washington State. If you're not an essential business or an essential employee of an essential business, and you're not able to work remotely, you very well probably qualify for this. The second category is if the employee has been advised by a healthcare provider to self-quarantine. This doesn't necessarily require a diagnosis. This could be for somebody with a pre-existing condition that makes them particularly vulnerable. Again, if they basically have a doctor's note saying they need to self-quarantine and they don't have the ability to work from home, or you don't have an accommodation for them to work from home, they would be entitled to those 80 hours for full-time employees. The third category would be employees that are experiencing COVID-19 symptoms and do not have a diagnosis yet, but are seeking a diagnosis. So folks, as we know, there's not a lot of availability for testing unless your symptoms are pretty severe in this area, and oftentimes not unless you're inpatient. So as long as the employee is attempting to get a diagnosis and working with their healthcare providers, and they have symptoms that are matching the CDC guidelines for what to be looking out for COVID-19, they're going to fall under this third category. So again, all 3 of those categories, the employees are entitled to 100% wage replacement for the paid time off for those initial 2 weeks. Now, there's some caveat here. It's a maximum of $511 a day per employee that you will have to pay out. So this isn't going to compensate employees that are making really high wages. It'll compensate them essentially to a certain point. And it's going to be a maximum of $5,110 per employee. So it's not endless coverage. Now, there are a couple of categories where employees are entitled to 2/3 of their wages during that period of time. The first category is if the employee is caring for an individual that is subject to a governmental order or healthcare provider direction to self-quarantine or isolate. So these are folks that are taking care of their grandparents, taking care of maybe their elderly neighbor, that sort of thing. They're helping somebody out and unable to get to work for 2 weeks because of it. The other category that is eligible for 2/3 wage during that period of time is employees that are caring for their child whose school or daycare provider is not able to provide services because of the COVID-19 pandemic. So this applies, to all those parents with school-age children, or parents with young children that are typically in daycare, and that daycare provider is no longer able to provide services because of COVID-19. Now, it's important to point out that these workers that are in these last 2 categories that are entitled to 2/3 of their compensation, that is a daily amount of $200, a maximum of $200 per employee, and a maximum of $2,000 over that 2-week period per employee. It's important for employers to understand that this leave is intermittent, right? So Typically, an employer might say, well, if you're going to take vacation, your vacation is going to be for the entire day. We don't allow partial day vacation. That's not the case for these paid time off programs. If your employee needs to leave for an hour to go to, the doctors or to take their child to the doctor because of COVID-19, and they fall under that category that they're taking care of somebody who's has to stay home or needs to go to a doctor. If they just need that hour outside of the workplace or away from their home working environment, it's just they're only cashing in on that hour's worth of time, and they still have their 79 remaining hours to use for other purposes. So it doesn't have to be used continuously. So there's an additional 10 weeks that can be added on to those 2 weeks that comes under an expansion of the FMLA program. So for most employees, really you're going to be seeing the 2 weeks of paid time off. That's going to be the most common thing that you see. But there's an additional 10 weeks that an employee is entitled to 2/3 of their wage if they are continuing to care for a child whose daycare or school is not open due to COVID-19. And that's a pretty big burden for employers to carry. It's a total of 12 weeks under those two programs for those types of employees, a maximum of $12,000 for that 12-week period of time that the employer is responsible for. And again, that's at 2/3 of that employee's wage, up to a maximum of $12,000 for that period of time. It's, again, these are really heavily fact-specific situations. And if you have employees that are struggling to do their job duties because there aren't remote working possibilities, be in close contact with your attorney and working with them to make sure you're fulfilling your obligations as an employer. In Washington State, as you probably know, we have some really broad laws that are very, very employee friendly, and as they should be, but they open an employer up to an enormous amount of liability for failure to pay wages. And I foresee there being a fair amount of litigation after this is all said and done and our courts are open again around whether an employer did or did not pay what they ought to have paid during their employees' time of need. So, again, there's an exception for employers that have fewer than 50 employees, but it's a very narrow exception, and you need to be very sure that you qualify before you decide to not pay employees. Otherwise, you open yourself up to quite a bit of liability. And I think Bonnie was going to touch on the tax implications of those paid leave programs.
Yes, so along with those rules for employees, in order to help ease the burden for employers, they came out with a bunch of tax credits. And those tax credits the paid family leave tax credit is probably the first one. And that is 100% of the qualified family leave wages. And they apply against the employer portion of OASID, which are your employer taxes, payroll taxes, that you pay on your Form 941. So, and actually you can start getting that money right away as soon as you file your quarterly 941. Those are due at the end of the month. So talk to your CPA about that payroll tax in order to start getting reimbursed on those wages that you're paying now. Like Jillian said, it's $200 in wages each day, or $500 depending on which type of leave they're taking. I won't reiterate exactly what she said, but it's exactly what the law is requiring you to pay your employee. That's the amount that you're going to get a tax credit for. Self-employed people, those are also eligible for these refundable credits against your income tax. So next year when you go to pay your income tax, any sort of this paid leave that you take or you want to take as a self-employed person, you are eligible for those refundable credits. And then there is also an employee retention credit, And so the point of that was to have employers keep their workforce on staff. If you laid everyone off, you lay everyone off, those people want to go get other jobs. They want to start earning an income. And when you are now able to open back up, you've lost your entire workforce. You have to retrain, rehire, bring those people back into the fold, assuming that that those people have already gotten jobs elsewhere. So they came up with this employee retention credit, and that credit allows you to take up to $10,000, 50% of that as a credit for paying your employees while you are under isolation or stay-at-home orders. So those, I would talk to your CPA. They're very tax specific. Generally, they're paid up pretty early in the process. A lot of times you don't get tax credits until the next year when you file your taxes, April 15th, or if you extend into the fall. So you get the benefit now. So I would talk to your CPAs, make sure that you're getting that credit if you're eligible. But that being said, there are other programs that you may qualify for that we'll discuss later. And so the second option might be to take those payroll credits. We've, in many instances, recommended first taking the PPP, the Paid Protection Program loan, or the economic injury disaster loan first, and then taking the credits. But now that we've run out of money, or the SBA has run out of money, it might make sense to then take those tax credits at this point. But it's a strategy that you want to talk to tax advisors about. So the other thing we wanted to discuss was the Paid Protection Program and the EIDL, or Economic Injury Disaster Loan. As Jillian mentioned, those are currently out of money. We've been told that Congress will get more money, but you never know. I think currently they're in a deadlock, so we don't know that that's a fact. Briefly, I'll do a quick overview for people that did qualify for it. You apply for the PPP loan through your bank. It covers payroll, mortgage interest, and rent. And there are specific percentages. So if you get the loan, 75% of that loan needs to go towards paying payroll. The other 25% can go towards your rent or your interest if you own the building that you use for business. The amount of the loan is 2.5 times your average monthly payroll. And it should cover at least 8 weeks of payroll for your employees. It is up to 100% forgivable, assuming you pay for the right things with that loan amount. And Jillian will discuss kind of the forgiveness piece about it. But that's just the quick overview on the PPP loan. The EIDL, or Economic Injury Disaster Loan, covers different expenses than the PPP loan. It can cover fixed debts. It can also cover payroll if you didn't get the PPP. It can cover your accounts payable or other expenses due to the disaster's impact. So that's a pretty broad range as far as covering expenses. The interest rate on that is 3.75% for a profit business. A not-for-profit business is 2.75%. And it's over 15 or 30 years, depending on a set of factors that we don't quite frankly know. The Chamber did do a great presentation, I think it was last week, with the Small Business Association on the specifics of the PP and the EIDL. So if you are interested in learning more, I would recommend going back and watching that. So.
Yeah, so as Bonnie mentioned, the great thing about the PPP loan, or the Paycheck Protection Program, is that up to 100% of it can be forgivable, meaning it's free money to infuse into your business to help you stay afloat during this time. What you need to do, though, is be really mindful about how you're using that money. As Bonnie mentioned, if you want your loan to be forgivable, 75% of it has to go to payroll costs. The remaining 25% or less can go to things like your mortgage insurance if you own your property, lease payments, or utility payments. So it's a pretty narrow set of costs that you can apply these funds to. But again, it's forgivable. So to the extent your loan isn't forgivable, it's not the worst case scenario. It's a 1% interest right now, which is, much less than you're going to get from any other commercial lender, much less than your line of credit. It can be a really big help to small businesses and help them get through this time. So other than the 75% requirement, there are a couple of ways that you might inadvertently reduce the amount of your loan that is forgivable. One way is by a reduction in your workforce. So there are essentially 2 time periods that you can choose to create your baseline. One is from last year. The other potential baseline time period is from first quarter 2020. And you'll want to count how many employees you had employed during those periods of time. And you'll use the time period where you had fewer employees to create a smaller baseline for yourself. And then you'll compare that to the number of employees you have employed through this period of time when your PPP loan originates, when you get those funds, through June 30. And if you have fewer employees, full-time equivalent employees, so part-time employees don't count as an entire employee, but they get added together. If you have fewer employees during this period of time after your loan originates, you're going to have a reduction on a percentage basis of how much of your loan is forgivable. So to make it really easy math, say you got $100,000 in your PPP loan, you had 10 employees at the beginning of the year, you reduced that, laid off 1 employee, and now you have 9. 90% of your loan is going to be forgivable, assuming that you used 75% for payroll and 25% or less for things like mortgage and mortgage interest, rent, and utilities. So it's, if you need to let somebody go, it's not the end of the world. It's going to be, you're still going to have a substantial part of your loan forgiven or eligible for forgiveness. But it's something you want to keep in mind when you're making those decisions, whether, to lay employees off. Again, these are laws that were passed really to incentivize businesses to keep people employed and keep the economy working as best as we can. The other thing you could do to inadvertently reduce the amount of your loan that's forgivable is a reduction in your retained employees' wages. So taking from our earlier example, say you have 10 employees at the beginning of quarter 1, 2020, you maintain all 10 employees, but you drop all their salaries by 50%. So you satisfy the first criteria in that you have the same number of people working for you, but unfortunately you've had to reduce their hours or you've had to reduce their wages by 50%. Well, in this scenario, the amount of your forgivable loan will also be reduced. So the measurement here is if any one employee has a reduction in wages more than 25%, you're going to have less of your loan forgiven. And this 25% mark is important because it is a tool for employers to reduce wages slightly, drop people down to part-time. So they're still making wages. The employer has a little bit more of a buffer, and 100% of your loan will still be forgivable. Again, anything beyond that 25%, and you're starting to reduce the amount of your loan that's forgivable. So all of this kind of comes with a caveat that the amount of your loan that is forgivable is measured by how much you spend in the 8 weeks after your loan originates. So if your loan originates on Monday, you get your $100,000 in the bank, you can apply that $100,000 to 8 weeks of payroll costs, leases, utilities, or mortgage interest. Anything used or anything remaining from those funds after those 8 weeks is not going to be eligible for forgiveness, but it still remains just at the 1% interest. So it's still pretty favorable terms.
Yep. Thank you, Jillian. The other piece we wanted to cover was the stimulus checks that are coming out. So many people have received them. If you didn't have direct deposit information in your tax return for 2018 or 19, you will be getting a paper check is what we have been hearing. Timeline on that, we don't know. We've heard anywhere from May through September, but you can go on to the www.irs.gov, and they do have a coronavirus tax relief section. And within that section, you can enter your bank account information for them to direct deposit that amount. You will have to have some information as far as your social security number, your bank account routing number, what your prior year AGI was or the last tax return you filed, 2018 or 19, and if you received a refund or you owed tax money and how much that was, just to verify your identity. The stimulus checks are $1,200 per individual and $500 for children 16 and under. So if you file single, your income has to be under $75,000 for the full $1,200, up to $99,000. You can get a prorated amount. So per $100 over that, it is reduced by $5. If you need to calculate what your stimulus payment is, you can quickly Google pay or stimulus check calculator in Google, and you can find a calculator to help you with that. For married filing jointly, the income threshold is under $150,000, all the way up to $198,000. So if you are a married couple and you make $100,000 a year with 2 children, you should expect $3,400 in a stimulus check. And ultimately, the big caveat or the big question on this is it's a prepayment of a tax credit that you will receive on your 2020 tax return. So if in 2020 you had a huge income spike and you were up to $200,000 for the year married filing joint, you will have to pay back any stimulus payments that you received. So this is a prepayment on a tax credit that you will receive next year. So you can do some tax planning around that, maybe bump up your 401k plan, put some of that money into your retirement account if you can afford it, in order to stay under those tax limits, in order to do that. Other thing too is if you have children that are in college or you have been claiming them as dependents, maybe it makes sense to not claim them as dependents. You need to talk to your CPA about how much support you're providing them and where they live during the year, and if they can qualify as a single taxpayer on their own without being a dependent of yours. But that is definitely something to look into on the stimulus checks. And another piece that's really important in my world is hacking and fraud. It is huge around tax. We've been hearing people calling and saying, hey, we need your bank information in order to process your stimulus check. That is not the IRS. That is a hacker or a fraudster. The IRS will never call your cell phone or your phone. The IRS always corresponds via snail mail. You won't receive an email from the IRS. That's fraud. So don't, if anyone calls you or texts you saying, hey, I need your information to process your stimulus check, do not give it to them. That's my biggest caveat there. I've also heard about texts that are going out to people saying that you've been in contact with someone that had coronavirus and here's a link. Don't click the link. That's not true. That's another fraudster. So just be really cognizant, because there are people preying upon the situation. They prey on people's fears. So right now is when people are doing that. Just be really cognizant of who's contacting you, what they're contacting you for, And don't give away any personal information unless you are 100% sure that that person needs to have that information. And that's kind of what I got on that. But yes, stimulus checks are coming. Talk to your advisors about how you want to structure that. And then do make sure that you realize that next year is really when this will all get reconciled as far as what your stimulus check was. So people that have a child in 2020 or in 2019 and they were not able to file their tax return in time, you will get your $500 the following year. So that's out there. Just be aware of that. And that's all I got on the tax side. So.
Are there any questions or lingering ideas about other information that we can kind of provide to help people out?
We haven't received any questions yet. So I think we're all good unless do you guys have anything else you'd like to touch on?
Just kind of, again, reiterating that these are all really fact-specific guidelines and programs. And Bonnie and I are both happy to help people that have questions. Feel free to give us a call and contact us. We're both working through this thing. So although all of our meetings are not going to be in person for a while, we're happy to give you a hand if you have some additional questions that pop up in the next few days or weeks.
All right. Well, with that, I think we'll go ahead and conclude. Thank you, Jillian and Bonnie, for your time today. You both covered a lot of information that is facing a lot of people and applies to a lot of people. So thank you. Oh, we had a question come in.
Oh.
So this question is, when we file taxes next year, do we include the stimulus check as income?
It will not be counted as taxable income, no.
Okay. And that one, Ira, that was in response to your question on Facebook. And I think that's everything. So thank you again to the both of you. For those of you viewing right now, just a reminder, our next webinar is going to be April 29th with Dee Boyle and Aaron Brooks. They're going to be talking about networking on LinkedIn and in person. So that'll be one a lot of people should attend. It's going to be a really fun session. And with that, thank you again to the both of you. And that concludes today's webinar.